Welcome back to the FlipNerd.com REI Classroom, where experts from across the real estate investing industry teach you quick lessons to take your business to the next level. And now, let's meet today's expert host.
Hi, everyone. It's Clint Coons of Anderson Business Advisors and the host of the REI Classroom. Today, I'm going to be talking about joint ventures and what not to do.
This REI Classroom real estate lesson is sponsored by UglyOpportunities.com.
You know, I work with a lot of real estate investors now who are interested in putting together a joint venture. Either they're the developer or they're the gap funder. Now, one thing I keep finding over and over again is that these individuals come to me with this joint venture agreement that they either pulled down off the internet or somebody gave to them as the deal sponsor and said, hey, invest some money into this deal and here's going to be your rate of return. I can tell you so many times that when I review these documents, it's not a document I'd ever recommend you sign. And the reason is that most people don't understand what a joint venture is. That is, if I'm going to get involved with someone to put together a real estate deal, be it a flip a house or a greater project, and we're going to put together a written joint venture agreement. Essentially what we're becoming is general partners. That is, if one of us does something wrong, the other person can be 100% liable for all the claims of the other person's creditor. This could be a huge problem because you think you're just loaning money to a venture with an expected rate of return, but the problem often is that by law, you've actually become a partner. And the reason is that most people who enter into a joint venture agreement, let's say as a gap funder, are looking for more than just interest. They're actually looking for a piece when the property sells. Well, at that instance, you've become actually an investor. You're invested in the partnership itself, in the endeavor. So your return is based upon the outcome. That looks like a general partnership to the court. So the problem you run into when you enter into these agreements is that, again, if something happens, you could be left holding the bag. So what should you do if you want to look to get into a joint venture with another party? First and foremost, never do it in your own name. Always enter into it either in a corporation or a limited liability company so you limit your personal liability exposure. Number two, the entity you use to enter into that joint venture agreement, make sure it doesn't have a lot of assets, because if something does go wrong, you don't want to be left holding the bag. Number three, if you absolutely want to enter into a joint venture, and there's plenty of opportunity to be made here from a financial standpoint, set up a limited liability company. Don't try to operate with a standard joint venture agreement between the parties because you leave too much room for error when you use a written joint venture agreement. An LLC clearly defines the outcome of what's to happen when the asset's sold. It provides asset protection to you. And so from this standpoint, as an investor, you a shield around that asset. More importantly, if you were funding a joint venture, many times you're coming in as a second, and maybe the first position lender won't allow there to be a second on the property, so you're unsecured. Well, if you set up an LLC between you and the developer, or if you're the developer and the gap funder, then both parties have an ownership interest in the underlying asset. So this idea that I need to have a second is no longer a concern. So you have security through the LLC. Fact of the matter is, joint ventures can be complicated and they can be traps for the unwary. Make sure you're setting it up right, seek advice ahead of time before you sign a document, and then go out there and make some money. My name's Clint Coons with Anderson Business Advisors, and I hope to catch you on the next go-around.
HomeVestors, the We Buy Ugly Houses folks, is a franchise system of hundreds of real estate investors that have purchased over 65,000 houses. If you'd like to learn more about the most powerful real estate investing system in existence, whether you're a pro looking to take your business to the next level, or whether you have no experience at all but a burning passion to be successful in real estate investing, please visit flipnerd.com/ugly to learn more. Please note, the views and opinions expressed by the individuals in this program do not necessarily reflect those of flipnerd.com or any of its partners, advertisers, or affiliates. Please consult professionals before making any investment or tax decisions, as real estate investing. Are you a member yet of flipnerd.com, the hottest real estate investing social community online? If not, you can join for free in less than 30 seconds and get access to hundreds of off-market deals, vendors in your market to help you in your business. And you can start networking with thousands of other investors just like you. Get your free account now at flipnerd.com. Please check out the Flip Nerd family of real estate investing shows, where you can access hundreds of expert interviews, quick tips, and lessons from leaders across the real estate investing industry. They're available at flipnerd.com/shows, or simply search for Flip Nerd in the iTunes store.